Welcome back to the channel, everybody. Today I want to talk about what I think is one of the hottest property sectors that's coming right now. And for that, I've got George Pino. He's the CEO of Commercial Brokers International. We're going to talk about single tenant net lease, or some of you might call them triple net deals. And George has done deals in, what do you know, 39 states?
39 and counting.
All right. So
trying to fill in the middle.
Yeah. So he has a little bit of experience in this. So George, thank you for coming on today. What trends are you seeing in commercial real estate as far as the single tenant net lease market right now?
You know, if anything, it's been picking up. You know, a lot of my clients for the last probably year and a half, they've been actually holding back and saying, you know, is this a good time to invest or not? With everything going on, both with combination with tariffs as well as the debt markets and interest rates being up, we of course saw a decompression in the cap rates where they've gone up. So the interesting part though is when you start tracking this, you know, back in the first quarter of 2024, we saw a year-over-year drop almost 50%, or a little bit above 50% actually, from sales in single-tenant net lease
Number of
assets.
sales?
Number of sales. Just over a 1 year period, almost half. Now, that being said, we're now seeing that, okay, the following quarter, the drop was closer to about 19%. Now, the last quarter here, it's 13%. Okay. So we're starting to see it actually come back and stabilize. So if anything, now may be the opportune time to do that actual investment in single-tenant net lease.
Yeah, it sounds like you're not going to hit the bottom, but you're on your way back up pretty quickly.
Sounds like it. Yep, it's looking like it. It's looking pretty strong right now across the board, actually, about that.
So let's talk about where cap rates were and where they're at now.
Okay, well, overall median cap rates, they dropped about 40 basis points overall from year over year from last year, and that's about, currently they're averaging about 6.9%. Now, of course, you know, you're not going to get a 6.9% McDonald's on a cap rate. So that's the average, and realistically speaking, you're probably looking at about a 300 to 400 basis point differential just on tenants, and we're only talking about really credit tenants, not just your mom and pops and things like that, in which case the differential in your cap rates are going to be even more so, where you're actually going to see cap rates like on a triple net deal or a STNL deal that may have a mom and pop and it's a small tertiary market, you could see cap rates as high as 10, 11%.
That's because they're higher risk.
Much higher risk. It's all about risk versus reward. So if you're going to go in and we want to invest in something that everyone else wants to because of the safety factor or the don't want to say the safety factor. I would say probably the impression of safety, such as McDonald's, Raising Cane's, In-N-Out, things like that are corporate guaranteed and long term, or you can actually go like a 7-Eleven that's S&P A rated. So you have a lot of that's available. One of the biggest trends right now is actually because of the big beautiful bill that was recently passed, has been bonus depreciation assets.
Yeah, I can imagine that's going to be triggering a lot of new acquisitions.
Not just acquisitions, I think development as well, which is the whole idea behind it. So, you know, the beautiful part about that, no pun intended about the big beautiful bill, but, you know, part of the big beautiful bill that was passed in May had to do with bonus depreciation, and a lot of those bonus depreciation assets are auto related, such as gas stations, car washes, things like that, where you can actually do 100% bonus depreciation year one. Now this offsets passive income or professional income. If you're a professional in real estate, you can offset that income as well. Always check with your accountant, though.
Yeah, absolutely. You know, we've kind of done a deep dive already. I want to kind of step back and,
sure,
you know, what really makes a single tenant net lease investment, or triple net lease, as some people, more attractive than, let's say, multi-tenant retail or any other commercial real estate investment asset class?
Well, you know, single tenant net lease has a lot of benefits for those people. Number one, you typically have a long-term lease. So you're going in knowing what your cash flows are going to be for periods 15, 20, even 40 years out. And typically speaking, though, you have at least a 15 to 20 year guaranteed lease on the initial lease start. So you're going in knowing that. So that's in and of itself is a safety factor. Number two is you also have insulation from expenses. So potential for insulation from inflation, meaning a lot of multifamily investors, they're getting hit hard right now, really hard. Their bottom line is getting hit really hard.
Sure.
even from last year, and it has nothing to do with the actual rents going up or down. It has to do with their expenses going up.
Right.
You know, insurance costs have doubled, tripled in some submarkets. In addition to that, the cost of construction and the make-ready costs, especially with the tariffs going into effect, is all causing a big increase in expenses that the landlord or owner has to take on. In a single tenant net lease, however, the tenant takes that on. They're responsible for all the maintenance, they're responsible for all the repairs, things along those lines, so that they actually end up taking that risk on themselves. The best part about that is, unlike other assets or other tenant classes, typically single tenant net lease is retail, and they're very much co-aligned. The tenant is very much co-aligned with the landlord in maintaining that property and keeping it up to the best standards and the nicest, cleanest.
Right. What does the typical lease look like for a single tenant net lease as far as term? Is it 20 year?
Well, depending on the asset, it's mixed right now, probably 15 to 20 years, depending on what it is. But there are also certain subsectors that have a little bit less. You know, coffee tends to be more in the 10-year, like so your Starbucks leases, they tend to be Starbucks, 7 Brew, Dutch Bros tends to be up to 15, but 10 for the most part. But then you also have healthcare, which, you know, a lot of people, that's been a real big sector right now. You'd want to go longer, but a lot of it's newer, like a lot of urgent care centers, things like that. And you're seeing those in the 10-year markets, you know, typically 10 to 15 year. Same goes with the dialysis companies. They tend to be in that 15-year, some 10, but 15-year lease structures. Meanwhile, QSRs, which fast food restaurants, they tend to be in the 20+ year terms.
Great answer, by the way. I had no idea that Starbucks is only 10-year. I assumed they were 20-year.
Yep. Nope. They tend to be 10. Every now and then you can get a 15 out of them.
Really? Depends on the property, right?
Location.
Yeah. So what are the top factors you look at when you're evaluating a single tenant net lease property?
You know, jumping right back to what I just said. Well, the lease is one thing, but first and foremost is location, because there's really no need to delve into who the tenant is, what the lease structure is, or anything else, if the location isn't strong. And that's actually probably the biggest mistake I see a lot of new single tenant net lease investors do. They're more cap rate driven than they are location driven.
Right.
So they go and look at properties that are generating more income, but there may be in a tertiary market that's going to be really hard to re-tenant or renew that lease even at that same rental rate. They assume that the tenants are going to renew at the same rental rate. I can tell you right now, every tenant out there, and this is just smart business, when it comes time to renew the rental rate, they're going to claim hardship and they're going to claim they're already overpaying.
Of course.
Okay? Every single tenant out there, even if they're not.
Right.
So they're not necessarily just going to fold over and renew that lease at that current rate. And in some cases, they may be right. You know, if you have land that is very low in cost and the cost of construction, like let's say it's a dollar store that has tilt-up construction that's, you know, you can build for $50 a square foot. Their rents that they're paying for a brand new location here in 10 years is probably not what the rents are going to be that they could if they just rebuilt a new one right next door. And since they're not so much location driven, but they're more of a destination retailer, meaning someone's is going to be willing to drive an extra 5 minutes out of the way to save $1 at a dollar store.
Right.
So because of that, they don't care that they're in the best locations. They don't care if they're paying the highest rent. In fact, they're just looking at this for more about expansion for their own company, because a lot of times they're the ones building these, setting that artificially higher rental rate, so to speak, and then selling it off and taking the funds there to expand.
But typically, aren't you looking for traffic counts? You're looking for, you know, the ability to access the property.
Absolutely. So, you know, with the location itself, we first start looking at the overall location, but then we start delving down into it. So we're looking at combination of traffic counts as well as traffic generators, meaning, you know, for instance, I looked at a property that was one of the top performing RBs in the nation, and I was like, well, they're in the middle of a small town in the Midwest out of nowhere. How in the heck can they be one of the top performing Arby's? And, well, they happen to be an out parcel that was at the only Walmart in about a 100-mile radius. And that Walmart literally had 6 million visits a year.
Yeah.
So that's where something falls out. So we're looking at traffic generators. Those could be anything from shopping malls or big anchor tenants, or you're an out parcel to the mall. It could be schools. It can be Dutch Bros had a great methodology when they were first opening. Is their demographic was teenage kids. They targeted high schools. As close as I can be to a high school, that's where I want to be. And they did that, and they did really well with that model and that idea. So we're looking at traffic generators, things that aren't necessarily going to move, that are always going to be there. They could be hospitals, whatever the case may be, and looking for the synergies with the brand and the tenant. Is it a dialysis center that has to be next to a hospital or should be? And those are the things that we look for from the location perspective. Now, from the lease perspective, we're looking at a few different things. A combination of going into it, lease term. That probably plays one of the biggest factor in the valuation of the property. So it's the lease term, but more importantly, and some people don't do this, and it's a mistake not to do this actual due diligence ahead of time, is really look at the exit strategy. What you're looking to do, how are you going to exit? Assuming, even if everything goes perfect, how are you going to exit to get the highest price? Because sometimes highest rent does not equal highest price. Because, I've seen leases that are in properties, single tenant net lease properties that have traded for a lower price at a higher rental rate, but they only had 2 years remaining on a lease versus a new 20-year lease that's at 10% lower on the rental rate because of the differential in the cap rates and the risk that's associated with buying a 2-year lease versus a 20-year lease. They're actually trading at a higher cap rate and for less. So we're looking at all of that. What is our exit strategy? So we're comparing the rents right now. Where are the rents compared to what the market rent is now? How is that rent growth going to look like? We're also taking a look at the demographics. Are the demographics in the area growing? Are they stable? Are they declining? How is it going to look for our client, or rather I shouldn't say our client, our tenant? Because ultimately the success of the tenant is going to weigh heavily on the success of the investment.
What is the biggest red flag you look for in a lease?
Carve-outs or language that isn't taking into account the length of the lease. Okay. Meaning certain little things, like sometimes you'll see something like, and I see this in a lot of the older single-tenant net lease, where the requirements for insurance may be not to current market standards because those requirements were written 15, 20 years ago. So that's where you have to be aware of in case you're looking to finance the deal, because if the tenant's not getting the insurance or not required to get insurance that is as high as what the lender wants, then guess what? That's going to be an expense out of your pocket. So you have to take a look at the whole thing. So those little things, also little carve outs, sometimes minor things that they, or I should say, a lot of sellers or sellers brokers position them to be minor, and in reality they might be a little bit more major. From there, we're looking at some other stuff, but it's more about, on the lease side, more about how to structure proposals and or offers and or negotiating process, like time frames, things like that. How long do they have to do it? Another thing I also look at is that you want to make sure that you have some sort, if you're purchasing this lease, that you have some sort of recourse against the tenant if they don't do something. A lot of times it's amazing. For instance, a lot of times, yes, rent is due on the first, but a lot of these QSR and a lot of these single tenant net lease properties don't have a clause for late fees. So what do you do if the rent's late?
Doesn't matter to them, they're going to pay it. Yeah.
Exactly. What are you going to do? The only thing you can do is foreclose. Or not foreclose, rather evict. Yeah. So if you're going to evict them, but that's a legal process that you have to start and go after, and you don't want to necessarily do that every time someone's just late. So those are the little red flags that we're looking for when we're looking at the lease itself.
Those are all good ones. Let's say I buy a property and there's 5 years left on the lease. I want to get it back up. How do I approach a lease renewal with that tenant if I've just bought the property?
Well, if you just bought the property, there's a couple things. One is, number one, and we say this with the negotiations and every time, put yourself in the other party's shoes. What's going to motivate them to make the deal happen? Meaning, I actually ran into this where I had a property that had 8 years remaining on the lease. Now, most people would say, there's 8 years remaining on the lease. They're not going to renegotiate. They're not going to renew anything. Why would they? So, which is probably true. In fact, when I first called that particular tenant up, their first response is, we have 8 years remaining on the lease. Why would we talk to you now? My response back was, well, you want to be here in 9 years, don't you? Because I know your location's doing really well. You're 160% above average store sales. You're paying percentage rent, it's only 5%, so your margins are fantastic. Don't you want to be here in 9 years and secure that now? And that was the route that we went in. Now, sometimes it may be a situation where they're under market and you're just not going to get them to be able to do anything until the end of the lease. They may have options, but this is also where you may have to sometimes give a little bit to get something. Meaning, I always advise clients that when it's time to sell, don't do anything until they talk to myself and see if we can reposition that lease to make it stronger. Meaning, I can sometimes go into a client that or a tenant that may have 4, 5, 6 years remaining on the lease, and sit there and say, I'll give you a $10,000 a year deduction off your rent right now if you sign a new 20-year lease. Sometimes they'll jump on that, and that may actually create a lot more value than keeping the higher rental rate for a shorter term. And so those are the approaches that we use and take a look at, but we do that going in, and if you've done your due diligence ahead of time, you already know how that store is doing, how is it performing compared to all the others in the system, how does it look overall, what are the benefits there, is it a trophy asset location, in which case you're going to have more leverage to be able to push them in or keep them there. So those are all the things that should be done up front, but that's the due diligence done up front when you acquire, but the strategy is when you're getting ready to sell, not before.
Do you ask them to remodel when you renegotiate quite often?
Sometimes.
Not very often?
No, not very often, because a lot of times they've already remodeled. So, going back to what I said earlier, that the tenant is very much co-aligned with the landlord to keep it up. So a lot of times we'll see it, a 20-year lease, generally speaking, if you have a QSR that's a 20-year lease, after 10 years, that property may be starting to look a little tired. After 15, it already is looking tired. Most of the time, they're going to remodel that space and they're going to revamp it or get it so that it looks a little bit nicer. Studies have shown that on a major remodel, generally speaking, you're looking at a 10 to 15% increase in sales the first year. So it's wonderful for them, and it's good for the landlord if they can do that. So that can be potentially part of the concession, saying, I'll reduce the rent, but I want you to commit to at least a $250,000 revamp or remodel or whatever it may be. That's not a whole lot of money in the big scheme of things, but it does help out for the business.
Absolutely. I'm sitting here thinking when I'm listening to you, the cap rate difference between, let's say, a pharmaceutical, like a Walgreens or CVS.
Not a good choice on that right now,
True,
with all the troubles they're having.
True. Compared to fast food, what are those cap rate? What's the differences between those cap rates?
Between different asset classes, each one is going to be varied, and it really depends on the market and the condition at the time, so to speak. Meaning, sometimes I can tell you that drugstores were very favorable, and investors really wanted them 5-6 years ago. Not so much now with all the problems that have been going on with Rite Aid and whatnot, and the bankruptcies and other issues and closures that we're seeing. So, we're seeing those cap rate differentials being a couple hundred basis points. But realistically speaking, we're looking at about a 300 to 400 basis points in cap rate. So at the very low end, and I taking out the submarkets, meaning certain submarkets like Los Angeles, New York City, they're going to be trading at a lower cap rate in general, typically 50 to 75 basis points. But if we're looking at just across the board, if I'm looking at the McDonald's at a 4.25 cap rate, I may be looking at a healthcare at a 7 cap. So about 300 basis points differential, about 250 to 300 basis points differential for that type of asset. Now, if it's an industrial property, that may be upwards of 8-9 cap. So it really depends on the asset class and kind of what is in favor right now, kind of in the moment. Even FSRs versus QSRs. So FSR being a fast service restaurant, those are your Applebee's, Chili's, Texas Roadhouse of the world, Olive Gardens, as opposed to QSRs, which are your fast foods restaurants. Even that's going to have about 100 to 150 basis point differential.
Okay. How is inflation impacting these leases? For single tenant net lease?
I think the smart investor is looking at it as actually a benefit,
Mm-hmm.
because again, as we discussed, a lot of the inflationary aspects are situated in a way that the tenant's going to be responsible for that. Now, what is of interest is that you have increases in rent growth that are typically not necessarily as high as your typical rental increases that you may see in a submarket. For instance, right now, most QSRs are situated at a 10% rent growth every 5 years, so 10% every 5 years.
Okay.
Meanwhile, you have submarkets that could be in the 2.5% to 3% every year, which would equate to anywhere from 15% on the high end versus 10% on the growth. The difference is, however, if you're looking at 15% rent increase on a multifamily asset, I would argue that your overall net, because of your increasing
Sure.
your expenses, is actually less than 10%.
Yeah.
So, and in some cases, may not even be keeping up with the actual inflationary rate. So, and that's just a factor of what people can actually pay. So ultimately, I think that inflation is a good thing overall for the single tenant net lease assets when it comes to investments. I think it does insulate the investor a little bit to that. And really, if you're going in understanding that here are the rent increases, here's my cash flow stream, it becomes a little bit less of an art and more of a science to really project what am I going to do with this property, how am I going to get my returns, and you're much more likely to actually hit those returns then because of that.
Yeah, that makes sense. I want to close with one question. If you were advising a first-time single tenant net lease investor or potential investor, what is the one thing that you think they should focus on the most?
Location.
Location.
Location and exit strategy. Location and exit strategy has to be what's focused on the very first. Meaning, I've said this before and I've said it many times, and I'm a firm believer in this. I am geographically agnostic, however extremely location driven.
Mm-hmm.
So I'll go anywhere within the United States for my own investments or for my clients' investments, wherever they may want to go. However, the properties I'm choosing to actually go and invest in are going to be the best properties in those neighborhoods. And the main reason is I'm looking for my exit strategy. How am I going to exit out of this? I think that is the most important thing that most people don't look at, especially when they're looking at a 15, 20-year lease term. They're thinking I can set it and forget it, which they can, and still be successful with it because time, generally everything is going to catch up. But a real true investor should be looking at, when they're first making a look at it, what is going to be my exit strategy if I have to exit? Because you never know what life throws you. That may be the case. And if you bought a dog looking only for cash flow, if you have to sell it 4 or 5 years down the road and you only have a few years remaining on the lease because you were going after cash flow, not for exit and not location, you may be stuck with taking a big loss and not actually getting what you expected to get.
What is your ideal property and location for an investment? Signalized intersection, I guarantee is you're going to say.
Well,
No center divider, because you want access to
Yeah.
turn into.
Yep, those are all the access, we're looking
Signage.
at visibility,
Mm-hmm.
accessibility, traffic counts, demographics. High demographics that are trending for what we're looking at for the type of business itself. Also, I'm looking at traffic generators. I think that's a big one. One of my clients, we were able to identify and acquire a property that, frankly, the best thing I would look for is best case scenario, the tenant goes out of business and I have to re-tenant it.
Yeah.
Okay, so I'm actually looking at that, and there are certain properties that we have that are sitting right now waiting for those tenants to either not renew the lease or waiting for the lease to expire or waiting for them to go out of business. I have one that is a bank, national credit bank, that is kitty corner to the Dallas Cowboy Stadium.
Mm-hmm.
Now they're paying a high rental rate, but I guarantee I can get a much higher rental rate from even 7-Eleven or somebody that is going to help service that, the actual Arlington Stadium there, the Cowboy Stadium.
Yep.
So,
That makes sense. All right, how do we get hold of you?
well, you can always get a hold of me. The easiest way is through my company. It's G Pino, Pino, at cbicommercial.com. or you can always just drop me a DM on my Instagram. That's also under gpino at cbicommercial.com. Try and keep it easy. Or they can always reach out via phone.
All right, George is also the CEO of Commercial Brokers International here in Los Angeles. He's my business partner. George, thank you for coming on today.
Thank you for having me.
And for those of you watching, thank you for tuning in today. If you could, please give us a like, and if you haven't done so, make sure you subscribe, and I'll see you again next week.